everyone. Welcome to the latest 3esi-Enersight webinar. Thanks for joining us. My name is Brittany Bluestein, Marketing Coordinator at 3esi-Enersight. Today's webinar is Probabilistic Modeling, Asset Development Evaluation on Multidimensional Goals, presented by Mark Darcy, Solutions Architect at 3esi-Enersight. The webinar you will see today is an expanded version of the original presentation from the SPE Petroleum Economics Workshop that took place this past April. With that, I'll hand it off to you, Mark.
Hi, everyone. I hope you're having a great day. As introduced, I am Mark, and I'm going to be talking about probabilistic modeling today, specifically targeting the asset development level. Now, traditionally, probabilistic analysis approaches have started anchored in the subsurface production and reserve risks. And whilst this is a good place to start an analysis, we believe that without considering the full value chain and its own inherent risks and opportunities, this can lead to the limited generation of insights, a key input to effective decision making. This can be particularly relevant if there is significant constraints present, economic or other, and may lead to a misplaced focus on inappropriate variables for what you are actually trying to achieve. Hence, today we are going to be looking at how you can do a project evaluation on multidimensional goals so that we can include analysis on the time characteristics of options and multiple non-value-based goals. And that's basically what we mean when we state multidimensional goals. That it isn't about just ranking two or more options on NPV, but looking at a range of output metrics from the different development options and seeing which ones fit the asset's aspirations. And whilst NPV is important, it may not be the most important, and accepting a small deduction may result in significantly different range of possible outcomes that better suit what you're actually trying to achieve. What we're going to do is start with the backdrop of a relatively simple sample investment decision to discuss multidimensional evaluation. And as part of this discussion, how to move from a single deterministic analysis process, which you're good at and you're used to how to intuit insights from 1,000+ runs, which really is a different ballgame. We're going to have a look at why multidimensional analysis is important, particularly for probabilistic runs, because you can see all the ranges of outcome metrics, as well as how some elements may be decoupled from each other relative to your perceptions, and how this can lead to fresh insights about what you should be focusing on and a greater appreciation for how to trade off between different variables such as cost and production. We're going to demonstrate the modeling and analysis process, really focusing on where you want to be spending your time in analysis. So firstly, we're going to touch on how data automation helps you manage the millions or billions of data points being generated. And really, this is how you leverage the increased computational capability, which is now available to manage your subsequently big data outputs. And what we're going to do is look at what sort of inputs can then be incorporated into the model that you're considering, and a sample of what interactions are possible. And so we're talking about the full value chain model, including production and economic inputs and constraints, and how deterministic inputs can be upgraded to probabilistic distribution functions, how if-then logic can then be injected to dynamically enable appropriate interactions between variables so that we ensure consistent and coherent outcomes. We're then going to look at 5 visualization examples and the insights that may be generated, so looking at value, cash flow, capital, production goals, and derived metrics. But really, this could be any important metric to you or your company. So from a process perspective, what we do is we start at the proprietary modeling software that you use for your asset development. And so in this case, what we offer is Enersight. And this allows the subsurface and above ground input uncertainties to be utilized via probabilistic distribution functions and primary correlation relationships, with then if-then logic layered in to enable the dynamic interactions. And the outputs of this is that you get your NPV, you get cash flow, capital spend, production, and again, anything that can be important for your company. But these are per realization. So every single realization has its own NPV, and it's consistent with the capital spend and production and costs that you're generating. Next, we distribute the results using the OData data protocol to a SQL server. And this could alternatively be using Power Pivot within Excel, and then the DAX language, or another database language, which if that is where your organizational competency lies. The point of this is that we're using an open data protocol to push the data to a repository, and so it's going to be robust and scalable, unlike Excel, as well as being seamless and fast, so you can use web scripts so that you're not directing traffic or pressing buttons. The data is all stored together, and you can forget about the copy and paste dilemmas that I'm sure we've all experienced. Subsequently, we then automatically get graphical outputs based on your particular choosing. You define the rules once for how you want to manipulate or view the different outputs, and then it works the same time every time. So you do the analysis this month, you do the analysis next month. You don't have to rebuild everything. You just have to give it the new set of inputs. Finally, we look at the visualization software. And here we're talking about Spotfire, Power BI, Tableau, or any other number of visualization tools out there. And here what we can see is we can see some sort of ranked outcomes. We can see cumulative probabilities, the likelihood of outcomes and goals. And we can look at it on a singular basis or on a comparative scenario basis to get a better insight about what a single opportunity might actually look like, or what two distinct choices could trade off towards. So really, this is about taking the heavy lifting of the analysis to help you focus on generating the models, generating insights, making decisions, going back, refining models, and then really focusing on that analysis. So really skipping the data manipulation side of things and focusing on analysis. So let's start looking at the example scenario and what sort of modeling we can look at including. So what we start with is an existing asset set. And so in this case, we have 3 processing plants, 6 fields, we've got water gathering facilities, delivery pipelines, sales points, and we've also got a non-op supply point. And so within the existing facilities, you pay capital to drill a well, you get production, you have to pay OPEX, you get revenues. Very standard stuff. And then within the non-op, you get volumes and you pay a tolling cost to that operator. And of course, this can be customized to whatever particular contract relationship that you have. And then there's 2 extra options that are now being considered. The first option is to expand a pipeline so that the alpha facility can have a 3rd field added to it. While the other option is to develop 2 neighboring areas as complete greenfield sites. They would include their own processing plant and water facilities and all the capital associated with that. So these are the two choices that we're facing. And so let's have a look about what that looks like once we build a bit further. So really, the expansion options is based upon the estimated ultimate recovery inputted per field as a cumulative probability range. That's the primary driver from which everything is driven off. Same in real life. And it's used to enable the dynamic generation of the number of wells per realization, including the chance of failure, whether that's geologically or commercially. Within the pipeline option, there's about a 10% chance of failure. And if successful, enables the general alpha facility to prolong its production further. The pipeline has a staggered incremental expansion so that it matches the requirement for gas as opposed to a large initial capital outlay. The asset option has a choice about which greenfield site to develop first. In this case, it would preferentially like to develop the delta area and then the echo. However, if the delta comes up with a fail, which has a 30% chance of occurring, echo would immediately be developed. However, it itself has a 45% chance of failure. In this expansion option, the capital is not staggered. but rather spent as a large chunk at the start for the actual facilities to be generated. So a different sort of cost profile. These facilities are also dynamically sized based upon the volumes of reserves available, including that scaling cost. So a large facility will be built if there's a large expected find. Looking further within the integrated model at the if-then logic, what we're really trying to do is translate the selected reservoir EUR into a time series of production, cost, and cash flow, and hence value within the realistic constraints of the full supply chain integrated model. So we start with the potential outcomes of the delta reservoir on the left here in the form of a cumulative probability from 0 to 100%. The selection of this probability could be correlated to your existing field based upon similar geological parameters such as permeability and how you collected the data. But pending the outcome you have in this case, there's a 15% chance of geological failure where you only incur initial exploration costs, a 35% chance of commercial failure where you incur initial exploration and appraisal costs, and then finally you have success where you decide that you have sufficient volumes available to justify developing the asset. From this, the expected number of wells can then be determined based upon the total BCFs available and the anticipated individual well performance curve, which could be partially correlated to the reservoir volumetric selection or some other factor as may be appropriate to your input set. Next, the facility size installed in this greenfield location can be posited based upon the expected success of the reservoir, with the wells drilled dynamically to match the available capacity. The drilling speed would be dependent upon the number of rigs and would also include the benefit of having learning curves for time and cost, as well as economies of scale where you have costs incurred. This facility capacity could be further modified based upon available expected utilization rates. Finally, at some point, this facility also reaches a minimum economic volumetric rate and is decommissioned, leaving not all the reserves recovered. Finally, there is the element of network constraints to be considered, as well as sales requirements, which causes a delay to the required online timing of these expansion options, as well as restrictions in the flow of potential. Once you've built this integrated model and generated the outcomes, we start getting to the visualization piece. And here the focus is really on what additional insights are available. Because P50 is only one outcome, and suddenly you have a lot more data that you can reframe the conversation. Specifically, you can look at losing the project ranking mindset, finding the right fit, taking into account both the risk tolerance of your company or asset team, as well as the specific asset goals and the time nature of some of these goals. It also provides an ability to inspect whether the asset will meet its commercial obligations over time, be that exploration spend or production volumes. It also helps identify additional opportunities which may be available or critical outcomes that need to be avoided. And finally, it allows more nuance to creep into the discussion trade-off between the metrics and their goals. And as we'll see, there is a trade-off to be had between NPV and production in this particular example from 2030. So let's start with the first visualization. And here we're looking at a cumulative distribution function. On the left-hand side, we have the likelihood of different NPV outcomes for the pipeline and asset options, as well as the base do-nothing option from 0 to 100%. Looking at the production curve on the right-hand side, we see that the asset option has significantly more reserve potential as an upside. However, we can also see that this upside is not actually captured within the NPV, such that it merely catches up to the value of the pipeline option. We can also see from this snapshot that you can interrogate the visualizations as required. So you can hover over a specific point and get the exact numbers, or export the data once it has been processed. We all know that deterministically coming up with a lower value and justifying that is very hard. But how do you generate credible and informative P10 to P90 ranges for your outcomes for each of your assets? This is where an integrated model really comes in handy, because it isn't just a matter of going from the P50 outcome on the production and saying that the production there will match the P50 NPV. So you could start with a deterministic input of the P50 outcome for each of the options. But then you need to think about how much would actually be recovered in order to come up with an equivalent value of production. And then you might have this at a P10 or P90. But again, is the recovery percentage the same? How much do you vary it? And looking at this chart, obviously you can see that it's not always going to be the same. Then you also need to understand speed of the recovery, the costs, and the price, and the changes in price in order to understand the true relationship of production to NPV. The beauty and power of the integrated model is that this is all done dynamically, and you're not feeding production-based outcomes to an Excel model and trying to guess these factors for thousands of runs, which would just be a nightmare. Looking further into the relationship between NPV and production, even if you could justify tying the decision back to a single metric like NPV, types of decisions you are comparing means that you are not achieving an apples-to-apples comparison, and it becomes essential to see that more than one lever is required for uncertainty and capital. So, within the base case, there's a very tight band of production outcomes leading to similar NPV outcomes. So, we have a correlation of 0.96, which is very strongly dependent. And that's a very good match. However, as more capital and more uncertainty is added, that correlation drops from 0.96 to 0.95 to 0.9 within the asset case. More importantly, the range of outcomes associated with production relative to NPV increases dramatically. And so you may end up with very similar production outcomes which have very different NPV, or two NPV instances could have vastly different production achievements. And really, it's about trading off between these two. As a part of this, we can see that it becomes less appropriate to use production as a proxy for NPV, the more independent and capital intensive the options you're considering become. The second set of visualizations is looking at the likelihood of achieving a goal and example outcomes. In this case, both associated with production. However, they could be any variable that you wish, including reserves or cash flow. Looking at the top section, we're evaluating the chance that the integrated scenarios from each probabilistic run will meet the production target of 160 mmCS a day. And what we see is, in the base case, it trails off quite early, whilst the two expansion options push out the ability for the asset to meet that goal significantly longer. The pipeline case has a better chance of meeting the goal at 2030. However, it declines faster. Pipeline also has a better NPV. But the real question for you and your asset team is, do you need to meet the goal in 2035 as well? And in that case, the asset option may actually be a better choice. Looking at the bottom, the realizations have been ranked so as to bring out representative cases for P10, P20, P30, P40, etc. In this case, it is the pipeline scenario and has been ranked on the NPV. However, you could actually change this selection based upon what's important for you, whether that was production over a certain period of time, meeting capital goals within a short time frame, or whatever may be more important to you. This and the previous couple of graphs show how the discount rate will drive which of the two options are better, as it shows how the asset option has the potential to persist longer in meeting a goal, whilst the pipeline option is faster to ramp up, retaining the plateau for longer before declining quickly. Thus, if you had reserve goals, the asset option could look better. The third set of visualizations is where we start looking at the contributors rather than the overall scenario. Here we can see which field or sub-asset are kicking goals or letting down the team. This helps shape the focus. If one of the assets is essentially stationary, then it may not need a lot of concentration, whilst others will drive the overall result and could do with extra scrutiny and analysis. In this, what we're doing is we're plotting the contribution of production by each field within an NPV rank for a scenario. You could also show this as cash flow per year within the same groupings. And this can obviously be customizable to, rather than a processing facility, you could have this at the subfield level to gain better insight about where your current development actions are versus your existing asset base. The final visualization we have is the famous bubble chart showing NPV on the y-axis, production on the x-axis, and a derived metric of NPV per production volume for the bubble size. The principal point of this visualization is to try and gain some insight about what you are doing to the field and how the risk outcomes lie. What we are particularly showing is all fields from the base case. And so we can see the alpha, beta, Charlie, delta, and echo. We also see from the pipeline case the revised alpha set, and from the asset case the delta and echo inputs. Within the pipeline choice, what we can compare is here is the P10 asset for alpha, and P50 and P90, and pursuing the pipeline option pushes the P90 to approximately a P50 outcome and further expands out both the NPV and the production on a relatively straight trajectory. And one point to really note is that there's no significant change in the size of the bubble. So essentially it's just more of the same. You're on a good thing, you expand it out, and it's a relatively simple play. The other option of developing the delta and echo assets is slightly different, whereby there's a large chance of failure which drags down these cases here, but they can expand out. Additionally, there are quite a much lower NPV to volume ratio, and so unless you hit really, really big in that P10 to P1 range, it's hard to justify that value. From this bubble chart, you could further iterate to create a creaming curve or any other sort of visualization that you're looking for. And really the point of this has just been to show a taste of what you could see from the outputs. So in summary, what we've gone through is an alternative methodology for generating insights towards improved decision making and gaining an increased analysis focus. So we started with an integrated modeling of production and economics. We added some robust risk relationships with if-then logics and probability distribution functions. We touched on how OData and databases can automate the extraction and evaluation, and then how you can focus on using advanced and sophisticated visualizations and analysis tools to really understand the insight. And really, it's about focusing on the modeling and the analysis, not the manipulation. And finally, we talked about the multidimensional fit of goals and clarifying the importance of assets rather than simply ranking. So this is about identifying the material drivers of decision making across the full spectrum of the decision space and asking the question, which investment choices outcomes match your risk tolerance and goal set. Thank you very much for your attendance today. I hope you found it informative. If you've got any questions or comments, please email us at info@3esi-Enersight.com and we'll get back to you. Cheers.